All right. Good afternoon, everyone. My name is Todd Davidson. I'm the leader of the Corporate and Tax Practice Group at Nexsen Pruet. I focus my practice on M&A, which is actually what they call it in New York. Down here, we call it buying and selling companies typically. And my role as the corporate attorney in an M&A deal is to kind of act like as the quarterback of the team, kind of giving out directions, keeping, hopefully moving in the right direction, not throwing too many interceptions, and giving other attorneys in the firm and other consultants and CPAs their roles in getting a deal done. So helping a seller sell a company is the most important transaction in their lives most of the time, and this is why it's such an important role that we play, and what an important how important it is for you to be prepared to make that sale. So today's webinar is called "Getting Your Business Ready to Sell." I would analogize it to when you want to sell your home. Oh gosh, I'm sorry. Yeah, sure. I thought I'd been on mute this whole time. Apologize. So I analogize it to selling your home. That's, you're not going to sell your home with it totally cluttered with major structural issues still in place. You're going to paint. You're going to clean up the cosmetic issues and try to make it look like you took good care of your house. If you're like me, you're going to probably put in about a $20,000 septic tank that you didn't want to have to put in, that you're never going to get money back for on the purchase price, because people don't pay for good septic tanks, but you have to because of issues that would prevent the sale of your house. Those are the kind of things we want to avoid when we're selling our company. Today's webinar is about maximizing your return. And that means getting the highest value and at the lowest cost and under the best structure for you, which needs to also take into account the tax impacts of the sale. It's never too early to get started prepping for the sale of a company. 3, 4, 5 years in advance is ideal. You don't want to start a month before. It's just too much work, and you're not going to get the results that you'd like to get. The format of the webinar today is just very conversational. There's not going to be PowerPoint presentations. It's just going to be discussions. The tape, or I guess links to this webinar, will be available within about 48 hours. So if you don't want to take notes, you can always listen to it again, but you can also take notes. There is a question and answer button that you can use to bring questions to the panelists, and I would encourage you to do so. At this time, I want to introduce our panelists. From GreerWalker CPA Group is Nicole Mottershead. Nicole is an insurance partner, and that's assurance partner, and is the transaction advisory services leader at GreerWalker, where she focuses on assisting clients with the process of buying and selling companies, including active involvement in the due diligence process, which is where I've worked with Nicole before, and creating quality of earnings reports, which we'll just tell you what those are during the webinar, and engaging in transaction consulting while always focusing on helping clients identify and minimize risk. David Jones is also with us from GreerWalker. David is a partner in GreerWalker's tax practice. He has 20+ years of experience in tax planning and compliance services for individuals and privately held companies. David focuses on manufacturing, distribution, and global services primarily, but serves a wide variety of companies from all industries. David is also quick with a joke, and he'll light up your smoke, and there's no place that he'd rather be today, I'm sure. So that is David. And then Sarah Batson is an employment partner in our firm, Nexsen Pruet. She also handles litigation. Sarah focuses on internal investigations and employment compliance issues. And she also helps employers navigate FLSA, FMLA, ADA, ADEA, OSHA, and many other regulatory issues, which are described with initials for some reason, but she's going to help you navigate those areas. She also assists our M&A team regularly with employment-related matters involved in our transactions. A good friend of Sarah's once told me that she finished first in her class in every level of schooling that she went through, including law school, which is particularly impressive to me because I barely finished my first class, is what I was trying to say. So, anyway, that's Sarah Batson. Next, I'm going to give a real brief overview of what we're talking about today. The process of selling a business involves essentially 5 stages. There is the preparation stage, which is what we're going to talk about today. That is getting your company ready to sell. This is the most important step in getting the value out of your business, but it's also the one that's most often ignored. That's why we're focusing on it today. The second stage is the letter of intent stage. Typically, you receive an indication of interest, or somebody contacts you about potentially buying your company, or you're working through an investment banker to market your company, and you receive a letter of intent, which sets out some basic framework for the acquisition. That letter of intent will include certain terms, including typically the deal structure, whether it be an asset purchase, stock purchase, or interest purchase, but also other key terms, business terms. And it's very important, of course, that you have attorneys review that before signing those, because they do have some binding elements. That stage then kicks off the next stage, which is the due diligence, contract negotiation, and disclosure stage. That is where the buyer engages in review of all of the documents and information you have on your business to see if it will, see if there's any issues that it needs to be aware of, which can impact adversely or positively the purchase price offer in the letter of intent. There's also a disclosure schedule process where you have to disclose any issues that are identified that could be problems, and certain other disclosures. And that process I would refer to as airing your dirty laundry. That's what we really want to prep for, to make sure we don't have a lot of things that are going to come up during that process that are going to cause you problems. Then there's the 4th stage, which is the closing, and the 5th stage, which is post-sale transition payment structure. This is where you're dealing with potential risks of having to indemnify the buyer for things that happened after the sale that may have been the result of acts taken during your watch. Also, this impacts earnouts, which are payments after closing based on future performance that you may be entitled to receive. So these are basically the 5 stages. Again, today we're focusing on the preparation stage, but it's important for you to understand all the other stages. The longer the process takes, the 5 stages, the more expensive it is to close the transaction, and the less likely you'll get the deal you want. So the prep stage is where we can take the steps to make sure this goes smoothly and efficiently. Time is the enemy of a deal. That's something I've learned over and over again, especially for the seller. The longer it takes, the more likely something might occur that will harm the deal. A great example is a lot of transactions that started in, say, October, November, December of 2020, and we're headed towards a closing in the spring of 21, were horribly impacted by COVID. So we saw a lot of deals just go away because of concerns with COVID. So these are, reasons why getting prepped and being ready to move forward is so important. I want to start with our seminar with discussions with Nicole and David about financial items and tax items that affect your return on investment when you sell your company. Nicole, I'll start with you, and we'll start with some of the basics. What criteria will likely be used to determine the value of a seller's business?
Yeah, thanks, Todd. And thanks for the introduction. I'm really excited to be here today and participate in this with the rest of the panelists. Yeah, so kind of going in out to market yourself, typically most prospective buyer is going to value your company based on a normalized EBITDA number. And I guess to step back, EBITDA is, a pretty simple formula. It's, your net income plus interest, tax, depreciation, and amortization. And so that gets you to your EBITDA number. Normalized EBITDA is factoring in items that are non-recurring or unusual. That's not business related. So, the prospective acquirer is going to give you a multiple of that. And the multiple is going to be typically, it's going to vary. The larger companies are going to trade at a higher multiple. And generally, the smaller the company will be at a lower multiple. But as far as the multiple itself, it's going to be, based on kind of the industry that your company operates in, and then also obviously the general market condition as well.
Fantastic. What things, and this is where I've worked with you before on some purchaser side due diligence, and in that particular matter had a lot of issues, but that were caused by the clients not being ready to close. But tell me about your role in the due diligence process, and in particular things that sort of make you cringe when you're representing a buyer looking at financial aspects of a selling company.
Yeah, so there's a variety of things that that will kind of deter, I guess, the financial due diligence process. But there's probably some that are pretty straightforward that a company can look at their process. But typically try not to limit the surprises in a transaction, and try to typically when you're talking to a potential acquirer, you are building a relationship too. Even post-transaction, typically you're gonna stay on kind of one way or another to help transition. So you want to build that trust, and part of building the trust is limiting the surprises that come out of it. So try to be upfront about issues, contingencies, and financial items. And I think that's in financials and legal and operations kind of across the board. But poor record keeping, inconsistent information or accounting methodology, and another, I guess, kind of big item, overarching item is kind of weaknesses within the management team and then the financial department. Most buyer, depending on how it's structured, most buyer are interested in looking at companies that are kind of can operate on its own, right? They want a strong management team that can kind of continue operating the business and are looking the same from the finance department. So that's a question that we always get is kind of our thoughts on the financial department and management through the due diligence process. And then, some other things are unusual revenue items, unsupported or overstated add backs. So I guess going back to that normalized EBITDA amount, the buyer wants to see what does your business operate at a typical level. And so, as you are looking at add backs, make sure that you can support it or show your methodology, right, to get to those numbers. And some add backs are perfectly clear and very easy to explain, but some, you have to put a little work into and kind of come up with sound methodology and a way to present it. It never felt.
I'm sorry, Nicole, can you give a couple examples of typical add backs?
Yeah, so I think we're going to touch it in more detail later, but I think one that I see on every transaction is personal expenses that are run through the business, right? I mean, most business owners have spent most of their life, working the business, and and it's very, I guess, typical and expected that there would be some personal expenses through the business. And so there would be an add back for that, right? Because it's not really technically, I guess, business related. But, you want to be able to support like such expenses, and really it kind of, it will help your valuation because you're actually increasing your EBITDA, for those add back. But that's one that we typically see. We'll see, typically revenue recognition is an area that will require some judgment or some work around. And then there are some that are a lot more complex, right? Like I did a deal this year where the company, in the last 4 or 5 years have done one or multiple acquisitions every year. And so, if you look at an audit report, for example, that's just historical data, right? This is what this year is, and this is what the next year is. But you want to show what the kind of that value that the company's at now by kind of normalizing all those acquisition. And you can show that through the due diligence and the QOE process. And that is typically, I would say on the more complex side of an add back, and you want to be able to support and talk through those adjustments.
Let's talk briefly about accounting methodologies. I had a deal recently that got really delayed because the sophisticated private equity group that was buying the company wanted representation to GAAP as the generally accepted accounting principles used to run the company. And the company representation to that was, we are the furthest thing from using GAAP humanly possible, which was not a good response and didn't help us with the private equity group. Can you tell us a little bit about the differences of the accounting methodology and what a business owner might want to look to do?
Yeah. And I think, as I was thinking about getting a company kind of ready to sell, this is probably where, you can make the biggest effort in, I guess. So to take a step back, I'll talk through kind of the different methodology and then talk about kind of those conversion. So, typically, businesses that are on the smaller side will be on a cash basis. And I think most of the time we're seeing that it's because their tax method, it's a favorable tax method. So the company keep their books under cash basis. And cash basis mean you are recording your financials when you receive a payment or when you pay for something. So that's cash method. And then the accrual method is you are recording your revenue when you earn the revenue and then recording the expense when you incur it, right? So just comparing those two, the accrual method would be a better representation of the business. If you're under cash method, typically we see a lot of fluctuation in your financials on a month-to-month and a year-to-year basis. And then to take it even a step further from the accrual method, you got GAAP, which is, I think, what most buyer would love to see, right? And want to see, because it's a basis of accounting that everybody understand, and it's based on a set of principles. So GAAP method, you take, accrual, and then you layer in areas that are subject to, estimates and reserves. So, okay, I made a sale, I record the account receivable, but then, and record the revenue, but how am I going to be able to collect that revenue, right? Or that AR, and should any of it be reserved? So that's, taking some of those kind of estimates further, and that will get you to accrual. And I think Todd, probably most of the deals we see, buyers are interested in the GAAP basis, and so talking through that GAAP conversion process, if you're looking to market yourself in the future, most interested buyer is going to want probably at least 3 years of financial information, through their process. And then if you go through kind of a formalized quality of earning process, which we'll touch more later, but a formalized QE, typically we are looking at least 2 periods. So typically, 1 year and a last 12-month period at a minimum, and then sometimes 3 periods. So, just based on how many periods we have to look at, really, if you're needing to do kind of a gap conversion, you want to start that process, 3-4 years before you're looking to go to market, typically.
Yeah, that's great advice. And you mentioned quality of earnings reports, or what we call Q of E's. If you could just touch real briefly on that before we turn it over to David to talk through some tax items.
Yeah, of course. So a quality of earnings, I think historically in the past, a quality of earnings it probably comes more from the buy side of, and that's kind of a more structured financial due diligence process, right, over finance and taxes. And then more and more in recent years, we're kind of seeing that shift to sell side quality of earnings a little bit, and it's probably equal, but sell side, it's the same, no matter which kind of side you're doing it. The sell side just kind of put you in the driver's seat of the process. Now you do kind of have to pay for it, but I think typically there's some great value from there, and I can go through that. But basically, for quality of earnings, you are looking at the quality of your incomes, identifying add backs, and kind of laying out what those add backs are related to, explaining it in a concise manner, and then also looking at presenting your assets as well, quality of assets, and what's in your assets, financial contingency, those type of things. And it's a formalized report from the quality of earnings standpoint. And then, so again, like I mentioned, the shift is getting a little bit more towards, we see more sell side QE now, and I think part of it is driven by the market, right? Even in COVID world that, Todd mentioned, post March, we're seeing LOIs that are wanting to close between 30 to 45 days. And that is, from LOI to closing, you got 30 days to go through all your financial diligence, legal diligence, and, operational consideration, and that's great, right? Like, I would love to sell a business within 30 days, but there's a lot to get through. So by doing some of the sell side kind of quality of earning steps, that would help, with that closing window. And then from a sell side QE, there's a lot of good things. It gives you, it gives you kind of a practice round of doing due diligence, right? Kind of seeing what questions you'll be asked and looking for areas of risk, right? Like, I want to know where a seller might be concerned about, and give myself the opportunity to try to clean that up, or at least figure out how to present it, And then I think just earlier talking about that example of a company doing a lot of acquisition, those things are really tough to describe and present. So the Q of E helps show those items. And I guess, lastly, on just kind of that financial due diligence and sell side Q of E, one thing is, most seller would love to find a buyer, the first time they try to sell their company, and have it all kind of work out, close within 30 days, and everything's all good. But in reality, that doesn't happen that often. And obviously preparing to sell your company will help with all that. But when you do a sell side QE, you're kind of in control of the process. And if a deal falls apart and you got to go back to market yourself, you can still use that QE, right? And update versus starting from scratch with another buyer. So I think there are some good things that would come out from doing, whether it's a formal quality of earnings or just having your CPA help you identify, gaps within your financials in general.
Yep, sorry for that delay. I'm having trouble unmuting. But the point you're making is that that preparation, that seller prep, is what allows you to close quickly. That it eliminates we're trying to eliminate some of the things that cause the delays, that cause buyer concerns, and makes buyers comfortable. And this is what this is all about. I'm going to go quickly now to David, and I wanted to talk a little bit about tax impacts on transactions and how to get in the right tax position as a seller. David, I know a lot of companies I represent, they will work very hard to minimize the taxes they have to pay each year, which I think makes a lot of sense. Is there a conflict between minimizing the taxes you pay and maximizing the value of your company when you sell it?
Thanks, Todd, and thanks for the introduction. I don't know why we agreed to mute while you were introducing us. That was a mistake in hindsight. This is a good question. As you noted, all of my clients want to pay the least possible tax every year, and I certainly understand that approach. It can lead to some surprises when you get around to selling the company. There are two basic ways to sell the company. As you noted earlier, Todd, you can have an equity deal where you sell your stock or membership interests in an LLC, or you could have an asset deal. And if you're going to have a stock deal where the acquirer is going to take over equity in the company, especially if it is a C corporation, then whatever you do now from a tax perspective has a direct impact on the buyer when they acquire the company. And if you take a lot of accelerated depreciation, for example, then the buyer has less tax basis in their fixed asset to depreciate once they acquire the assets. And if you think about it in the financial statement context, when you take a lot of depreciation, you're creating a future tax liability if you have GAAP financial statements, because you have taken less depreciation for book purposes and more for tax. So you're gonna have a higher taxable income later than your book income, and that has, as I said, a direct impact on what the buyer is going to have for tax benefits down the road, or they're going to have to deal with that liability. Nicole talked about cash basis, and if you're keeping your books on a cash basis, then the buyer may not be able to keep it on the cash basis, and therefore there's going to be some tax implication to that. If you don't have a stock deal, then there are less issues on the value of the company, but you need to be prepared for a higher tax liability probably when you sell your company. So if I'm selling assets for $10 million and those assets, and I don't have any tax basis in those assets, then my gain is $10 million. If I have $5 million of basis in my assets, then I have a $5 million gain. So the amount of taxable income is directly tied to how much basis remains in my assets. And when you sell, you probably also are doing what's called a cash-free, debt-free deal where you have to pay off debts. So let's say prior to the sale, you've leveraged up to acquire a bunch of fixed assets. You got a loan for $1 million and bought $1 million of fixed assets, and then immediately depreciated those assets. In the year you took the depreciation, you got all those tax benefits, and that's great. When you receive $1 million in the next year for those same assets, you have no tax basis, and you're going to have a gain of $1 million, which you're going to pay tax on. But you also have to pay off the debt that you took out to acquire those assets. So you're going to have no cash and a tax liability. And that whipsaw effect of accelerated depreciation, I think, is what surprises business owners most frequently in a deal.
Yeah, so that's one mistake that you see business owners make. Or another one that I've seen in some recent deals relates to sometimes income tax that may be due in other jurisdictions, other states, other countries, but also sales and use tax claims in particular from other states. And this frequently comes back in the indemnification stage, where the buyer finds out after the fact that there were unpaid sales tax liabilities, or at least potential ones, and they want to go back after the seller to collect those. What are the standards? Briefly, how do you evaluate where tax filings for both sales tax and income tax should be made?
That's a great question. I mean, this goes back to the minimization question. Year to year, I have clients that don't want to file in a lot of different states, and that's understandable. There's a cost to compliance. You have to pay the tax. And so sometimes in states where you don't have a lot of business, you may choose not to file for income tax in those states. But that can lead to consequences upon sale. Let's talk a little bit about what drives requirements to file outside of the state in which you may have your main business. Essentially, if you have assets, rent, payroll, or sales in any state outside of your home state, you need to analyze whether or not you have filing obligations for income tax, what are called gross receipts taxes, sales and use tax, and maybe payroll tax as well. And property tax. So there's all these different state and local tax obligations, and it can get very confusing because every single state and locality has a different mechanism for assessing and collecting the tax and determination as to whether or not you have a filing requirement. There are some general rules, and those general rules, when it comes to sales and use tax, have changed very recently. Generally, if you have anybody who is traveling into a state, or whether that's an employee or a contractor, you've created what's called a nexus, or a taxable presence, for sales and use tax. And that's historically been the rule, but there was a Supreme Court case a year or two ago called Wayfair, which changed that rule to require those that have generally over $200,000 of sales, or over $100,000 of sales, or over 200 transactions. Those are sort of the thresholds that might create a taxable presence for sales and use tax, even if you never travel into the state. So this has created a situation where a lot of businesses have sales and use tax nexus everywhere, but don't realize it, and they haven't gone through the proper steps to determine that. It's really important you work with somebody early on, way before a sale, to figure out if these things are an issue. Once you figure out whether you have an issue, then you have to figure out how to come forward and deal with it. And sales and use tax, whether or not that's an issue for you may depend on what type of business you're in. If you're selling to those who would resell your products, or you're selling to manufacturers, there can be exemptions for sales and use tax. The buyer may not be subject to sales tax, and as a result, they can give you an exemption. If you are in the type of business where you're selling to somebody who is exempt, you have to make sure you're collecting the resale certificates that apply where you're shipping the goods. It doesn't matter where your customer is located, or whether you're shipping to 5 different places. You need to collect resale certificates or manufacturing exemptions in all the states that apply if you're not filing, so that you can prove to a buyer or to a tax authority that you don't have a liability. If you're not selling to those who are reselling or manufacturing and have an exemption, it's even more important that you're really staying in compliance, because then you have an ability at the time of sale to collect sales tax and then remit it. And it's not coming from your funds, it's coming from your customers' funds. If you wait 5 years down the road and there's a sale, or the tax authority is asking questions, it's going to be hard to go back to a customer at that point and collect the sales tax. So it sort of becomes your liability. And there is a joint liability. The tax authority will take the position that even though the ultimate liability lies with your customer because they bought the goods, you, as the party that should have collected the tax, are on the hook for those taxes. So sales and use tax is a huge issue. State income tax can also be a big issue, because there are similar nexus thresholds. There are some limitations on states if all you do is sell tangible goods into a state, and you transfer those tangible goods via a common carrier, currently there are limitations on states to issue or to require you to pay income tax on those transactions. But those limitations are very tight, and even if you think you qualify, you need to be going over states where you have a lot of gross receipts to make sure that your advisor and you agree there's no obligation there. Besides income tax and sales and use tax, there are all these other taxes out there that you have to think about. I talked about gross receipts taxes. Those are applicable in certain states like Washington State, Texas, Ohio. They've implemented those specifically to get around those protections that are in other states where you're selling tangible goods. So, if you're a tangible, or even if you don't think you've created nexus in other states, you may have nexus in these states that have gross receipts taxes. And then you also have to be concerned about payroll taxes, especially in these times, in these COVID times, because a lot of companies have said all our employees are going to work from home or some portion of them, and their homes may not be in the state you're actually located in, which can create nexus issues for payroll tax, for income tax, sales and use tax. There may be some exceptions that states have put into place because of COVID, but this often gets missed. People will have salespeople that are covering the West Coast, for example. They're headquartered here on the East Coast, and they have a salesperson on the West Coast, and they are not filing payroll tax returns in California where their salesperson is located. And that would be required in that scenario if they're working there full time. And then the last thing that comes up that's state and local tax related is property tax. If you have property in other states, you technically have a personal property tax filing requirement, or if you have real property, maybe a real property tax. And those types of taxes, both real property tax and sales tax, can create issues on an asset sale. When it comes to payroll tax and income tax, typically that's not going to create an issue unless you have a sale of equity. But in pretty much every deal, this issue arises in due diligence, and the buyer is concerned about it because it can have such far-reaching implications. There can be a lot of costs to compliance, not to mention the tax plus penalties and interest. So if you don't address those things now, well ahead of a sale, you could end up with a delay in the transaction, a loss of some amount of the sales price, or they may require you to put a huge amount of money into some sort of escrow in order to have that money available should any of the states come back and want to collect on these liabilities.
Yeah, David, it's one thing for the seller to have to put some money, its proceeds in escrow to cover potential expenses. But it's another when they actually become reality, and that money is then paid to pay those claims, and the seller never sees it. So they think they're going to get one purchase price, and they get a much lower one. So that's exactly what happens in some of these transactions. Real quickly, jumping to some of the ways that these business owners can increase their return on investment related with tax planning in advance. I know you've hit on some of those already, but maybe just cover some other highlights if you could.
Yeah, so I think one thing that people need to think about is, Nicole touched on the fact that executive team is an important piece of any transaction, and this may not be directly related to tax, although it does have some tax impact. You really need to go through a process of retaining those executives. So you may have to think about some sort of deferred compensation plan ahead of a transaction where executives get paid at the time of a sale, and that way they'll stick around. Because if you don't have that management team in place, you're not going to be able to sell. Or even if you do sell, you're not going to be able to get out of the business. You're going to be stuck managing it for a long period of time. So that's one thing to think about. In addition to compensating them related to the sale and getting to the sale, you may also want to compensate them for the work they did at the time of sale, which is going to be above and beyond their normal day-to-day. Plus, you may have some incentive to compensate them once the sale is done in order to make sure you meet your earnout. So there's a lot of things to think about in regard to executive compensation, and those types of plans have different tax implications that you have to consider. Making sure that you hire somebody who has a deep knowledge of various tax planning opportunities and state and local tax prior to the transaction is important. As we talked about before, getting ahead of all those state and local tax issues is key. But in addition to that, having somebody help you with tax projections early on, maybe even before an LOI, when you kind of have a sense of what your EBITDA multiple would be, so you can figure out what is my net potential cash from this transaction after taxes. Am I ready to go through with a deal based on that net cash amount? And then those projections can be updated at the time of LOI, and again, as further documentation is produced, in order to further refine the numbers, so you really have a sense of what's going on. I think those are the main things that I would say. I mean, really just making sure you're planning for the transaction and are well aware ahead of time what your net cash is going to be. I think that's what drives most decisions that I've seen for my business owners is, I think I need X amount of dollars in order to sell this business and retire and feel comfortable. And if you don't know you're going to get that amount, or you go blindly into the deal, you could end up with an answer that is well below your expectations, and you then might have to back out or be frustrated with the results when you could have been prepared.
David, we had an excellent question from one of the participants who was asking which organization is easier to sell, an S Corp or a C Corp?
I don't know. Well, so a buyer of an S corporation may not qualify to be an owner of an S corporation. So they may require an asset sale, or there may have to be some structuring to sell the S corp, especially if you're going to have some retained interest in the new entity. That's another reason to really be dealing with competent tax advisors prior to the LOI, is if you need to do some restructuring in order to have a tax efficient sale, you want to do that. A C Corp is not necessarily harder to sell depending upon who the buyer is. If the buyer is a large public company, then they may not care about buying equity in a C corporation. But if you're the seller of a C corporation, a lot of times the seller wants to obtain the best tax results, which means they're looking for capital gains. As a seller of a C corporation, that means you probably want to sell your stock. But a buyer doesn't necessarily want to buy stock in a C corporation because they now have inherited your structure that requires double taxation. They also can't get a step up in the basis of the assets within the C corporation and take additional depreciation and amortization based on the purchase price they paid to you. That's different in the case of an S corporation, where you might be able to sell assets and only have one level of taxation and have capital gain to the owner. Or if you sold equity with an S corporation, you can make an election under Code Section 338 where you can treat it as an asset sale for tax purposes. So I think S corporations are more flexible. It may require some planning because not everybody can be an owner of an S corporation. And, there is an ability, if you're a C Corp owner, to convert to an S corporation prior to a sale. There are better tax implications of that conversion if you know that well ahead of time, rather than doing it a month before the transaction.
Okay, thank you, David. I'm going to move now, in the interest of time, over to Sarah Batson, who's going to respond to some of the employment-related steps you can take to maximize your return on investment in the sale of a company. Sarah, some of the it's important for potential sellers to know what buyers are going to be looking for related to employment-related information during due diligence. Could you maybe hit on some of the key points there?
Sure. So as an employment lawyer, maybe I'm biased, but I like to say that your employees are a company's greatest asset, but at times they can be one of your significant sources of liability. And so your employee base is what comprises your company. And sometimes that differs from industry to industry. But I think that when a company is looking at selling, the buyer is going to ask for information and due diligence to assess the benefit and the risks of the employee base. And so they will ask for things like your employee handbook, your policies, to see if they're compliant and you have what's required. They're going to ask for a list of your employees with their compensation and dates of hire, job titles. They're going to ask for information related to paid time off and job descriptions. And they're going to ask for information basically that will allow them to determine, is your HR house in order? Do you have proper documentation of the employment relationships that you've established with your employees? And are you in compliance? Are there any lurking risks if there was an audit from a government agency, or if there was a termination of an employee where an issue raised wasn't properly reviewed and addressed? They'll ask about former, pending, and prospective employment related liabilities. So they'll ask for settlement agreements, make sure they're enforceable. So if you say, oh yeah, we settled that case, and your settlement agreement is not solid, the buyer is going to want to know that. Any kind of prospective liabilities. So if you have an ongoing investigation into a discrimination or harassment claim, that's something that they're going to want to know before they buy the company. And they're going to want to know details about that. And they're going to probably want it resolved before you close. Then there's going to be questions on like prospective liabilities. Have you gotten any demand letters, any threats? And do you know that you're not in compliance? Like, for example, is your immigration paperwork, are your processes compliant and do you have the documentation going back a certain amount of time? One important part of looking at, is this deal going to be successful, is looking at integrating the purchaser's business with the buyers. And a lot of that has to do with employees and culture. Sometimes I think that what makes a purchase not successful in the end is a lot of times related to like incompatibility, sometimes with people. People are complicated. And so the purchaser is going to want to understand, what do your employment agreements say? Who are these key employees? Who's running the show, and how do we retain those folks? What are their agreements? What keeps them here? Do you have any provisions in any of your agreements that would allow the employees some kind of payout that would encourage them to leave on a change in control? Or, is there anything that you think is you're set up so that if you sell the business that you might lose some key folks who are going to get some kind of payout? Do they have any claim promises, maybe not, of equity in the event of a change in control or vesting of any benefits? So humans are complicated, and that's why I love doing employment law, but it can certainly throw a wrench in a deal. And so I think that it's really important, if you're looking at, in 5 years, I'd like to sell, to try to really get your house in order from an employment perspective and make sure you have the documentation you need. If you need to revise agreements, and make sure you have consideration for those. Look at the restrictive covenant agreements that you have, the retention agreements that you have if you pay anyone a bonus for staying on a certain amount of time. Take a close look at that. Make sure that you're not promising, like, those are still at-will agreements, where if a purchaser bought your company and they determined that certain folks weren't working out, they wouldn't be bound to certain severance provisions or exposed to breach of contract action for separating certain folks. And there's always a chance of redundancy. And so one mistake I see folks make is thinking that all the everyone's going to live happily ever after a deal, and not really thinking like some people aren't going to work out, and I can't always predict who. So I want to make sure that we've had a proper performance management process in place and given the hard feedback that needs to be given, so that we're not, you know, there may be some bad eggs that the purchaser will inherit, but if those bad eggs are terminated and their performance reviews are all glowing, then the purchaser is going to have a mess to clean up, and there may be some allegations of discrimination if someone thinks that they were performing very well and then they're terminated, and they have reported some concern, that some legally protected concern that makes them a whistleblower, or they have a disability, or they're in a protected category based on their race or national origin or sex. So I think that I hope I'm not going too far into the weeds on this, Todd, but I think that it is important to really take a close look at what your exposure is from a compliance perspective and what your agreements and policies say. Look at your unemployment history. Look at your turnover. They're going to want to know your history with workers' comp. Have there been workplace safety issues? And so they'll take a close look at all of that to try to assess what are they really buying and what are they going to look at post acquisition.
Yeah, I think one of the key things that you're describing is that these actions to prep for a potential future sale actually provide immediate value in a lot of situations. You know, you're getting compliant, you're following policies, you have policies, you created policies. Those steps create benefits if you continue to own the company for 10 years or if you sell in 3. So it's all good. It's a good process to go through, even if you don't have any thoughts of selling in the next 3 years. Sarah, one of the things you mentioned was holding on key employees. I've seen a few deals end because key employees were thought that they would not stay if someone bought a company. Is there some methodologies that current owners can use to tie those folks down?
Yeah, so I mean, you can certainly offer key employees a retention agreement. So you can offer them, if you stay in 6 months, you'll get this amount. If you stay in a year, you'll get this amount. 18 months, you'll get this amount. And sometimes we see if you can get a key employee over the bump of the transition, that hard transition, and they start to make connections with the new owners, that sometimes the new owners can then take the ball and run with it and carry it. But they want to know that at least in that transition where you're doing a lot of the hard work of getting your hands around the business, that those key employees will be there. And you can, I mean, a lot of times it comes to money, and then the purchaser, I mean, sometimes we see that there can be some challenges between the buyer and seller when they're negotiating. And one mistake sometimes buyers can make is sharing with those key employees, like as confidants during the deal, like criticism of a potential seller or concerns of a potential seller, and that can cause alarm among key employees. And so the one thing you really want to think about is like the seller's success can benefit you as well as the purchaser's success can benefit the seller. It's in the best interest of the seller. You're not like on closing day, you're just like done. You know, you really do want the purchaser to be successful. You want them to retain those employees. And so I think trying to work cooperatively with the seller to make sure that those key employees stay, that they're optimistic about the deal, and that you're communicating with them about the value and the needs to help that integration be successful can really help. But from a legal perspective, I mean, paying people with agreements so that you have a carrot for reaching these milestones is one tactic. Another tactic can be, incentive plans. Depending on how large the company is, you can do more complicated benefit plans offered to executives or to all employees, or a tiered system where if you're there, there's like a third vesting over 3 years is a common structure where you're giving folks incentives that you can give an incentive now, but it vests, you don't get to take it home if you leave. It vests over a period of time. And then those can be stacked. And those can be really helpful to rewarding employees for sticking through tough times.
Sarah, there was one question about best timing for disclosing potential sale to the employees. What I typically see is, well, it varies a good bit. Sometimes employees are in the know for a while. Other times it is literally the day they're terminated in an asset sale and they're picked up by the other party. Do you have any advice on what the best timing is?
I think it's really a case-by-case situation. I mean, some businesses are just so large that, and there are so many tricky legal issues as you're reaching closing date that you really can't disclose that the sale is coming until the deed is done almost. And then there's some period where you try to announce that the sale, like announce that there's an integration over time and try to not make it like, okay, we sold today, you have a new boss. I mean, you try to say, we are in the process of transitioning ownership to so-and-so. But I definitely think we take it on a case-by-case basis. There may be a small group of key employees that you do share with in advance, and they're in the loop. But there's always a risk when confidentiality is of paramount concern that the more people you tell, the greater risk you have that everyone in the company is going to know the next day. And this is big news. It's alarming news. And anytime employees start to panic, it spreads like wildfire. At the same time, if you can give notice and you can get folks optimistic about it and talk about, the owner's role in the transition or whatever would help employees feel comfortable, that can really help build some confidence in the buyer from the employee side, that the buyer and seller are working together. But I welcome feedback. I mean, we've all been involved in different deals, so I welcome feedback from all of you guys on what you've seen be successful. I will say that, when we work on writing out these communications, we'll give talking points to managers so that everyone's kind of, no one's saying opposite things. We give everybody talking points. We tell them what you can and can't say. We have employees who are in the know sign NDAs so they know this is serious. Like if you're in the know, if you're in this circle of trust, you have to sign your name that you're not going to talk about this with anyone, and that can help you.
Well, thank you, Sarah. I've got some items I just want to call to attention real briefly before we open it up to some additional questions and answers. Some of the key things that I've seen in transactions that have caused delays or cost items in purchase prices or later post-sale indemnification issues include third-party consent requirements and contracts, key contracts with suppliers, key contracts with purchasers or clients, customers. Those elements will often require that there be approval of the transfer to the new owner. And so you want to be sure to be able to line those up quickly. You want to do a lien search before you even begin this process to make sure all the old liens that are against any assets you have, like you borrowed some money on some equipment. Companies that lend money to businesses are really good about getting UCC-1 financing statements filed, but they're horrible about terminating them. And that cleanup process can really delay a closing and cost you a lot of money. Related party contracts, deals, you hire your son-in-law with a great employment agreement, and then there's a divorce in the family, and there's a horrible scenario that the buyer might be picking up. Those kind of issues can cause problems, and it happens more than it's always the son-in-law. Contracts you've entered into that have restrictive covenants that prevent you from competing in certain areas. This other company that's buying you may compete in that area, and it may cause a serious problem for them in acquiring your assets or cost you a lot of money. Environmental concerns, failure to register your IP, and not having really strong privacy and data security issues are some of the real key elements that I've seen in deals lately that have hurt sellers in their purchase price or their costs. That's the main part of the program. I know it's about 1:02. I think Sarah might have to jump off, but the rest of us are here to answer any additional questions you may have. There is a question about, and this may be for David primarily, with the new administration starting today, do we need to expect some significant changes in the buying and selling process of businesses? What I believe is that might be probably a primarily tax-sensitive issue, David, but there may be other issues I'll need to think about on that. What do you think?
Well, I mean, one thing that has been discussed is that Biden has proposed an increased rate on capital gains, like significantly increased. And since Democrats have the ability to pass legislation, given the elections in Georgia, that certainly is a concern for clients. From a timing perspective, I think there's a question about whether or when that type of legislation might pass if there were tax reform done by the Democrats to meet some of their goals. It seems like it would be difficult to get that done this year, given all that's going on in our society. And so a lot of people I've talked to are sort of thinking that may be a future issue to be concerned about. Whether or not Biden and the Democrats change anything, people may remember that at the end of 2017, there was a large part of tax reform that changed a huge amount of tax law. And many of those provisions, as they apply to individuals, are going to expire. I think it's in 2025 or 26. And when they do, tax rates for individuals are going to essentially go up. So I think those are things to be aware of in regard to timing. Other changes from the administration, I'm not sure what there might be that would impact things specifically. I think you just have to be aware of what's changing or what might be changing and think about that from a timing perspective, at least when it comes to tax.
Okay. And I think I think we're a little past our time on this. I don't have any more questions in the chat, in the Q&A section of the chat for us to answer. So I want to thank the panelists today for participating. It was very good to work with you guys on this and prep for it and in the process. And Eric Pinkett, thank you for helping us set this up. Also Kelly and Jackie Spivey at our firm. We greatly appreciate all the help. This will be available in about 48 hours to be downloaded, or we can send you copies. We will make sure that anyone who wants this will have access to it. All right. Thank you, everybody.
Thanks, Todd.
Thank you, Todd.
Thank you.
Nice to be with you, David and Nicole.
Have a great day, guys.
Bye.